ChargePoint stock has taken a beating lately, down 57% just over the past 6 months. And with recent tariffs, slowing EV adoption, and hybrid vehicles gaining market share, many investors are wondering if this EV charging equipment maker can bounce back. In this video, I'm going to break down where ChargePoint could be in the next 12 months and why I believe investors may want to steer clear for now. Let's start by looking at ChargePoint's recent results. The company released fourth quarter and fiscal 2025 earnings on March 4th, and the report showed that revenue plunged 18% to $417 million for the year. ChargePoint's hardware sales, which is what the company calls network charging systems, took the biggest hit, dropping 35% from the previous year to $235 million. During the conference call, CEO Rick Wilmer did highlight some positive developments. He noted that subscription revenue grew 14% in the fourth quarter to $38 million, showing the recurring revenue side of the business is still gaining traction. CEO also pointed out that customers completed 27 million charging sessions in that quarter alone. According to Wilmer, existing EV charging infrastructure faces significant pressure, and additional capacity has to move from want to a need for consumers. Now, the company's made progress in operational efficiency as well. ChargePoint's gross margin, which is the percentage of revenue left after subtracting the cost of goods sold, improved to 30% in the fourth quarter, up from 22% a year earlier. The company also cut operating expenses by 30% compared to a year ago. Cash consumption also dramatically improved, with the CFO noting that the company used just $3 million in the fourth quarter compared to $31 million the previous quarter. But the industry trends don't seem to be working in the company's favor. The electric revolution that seemed unstoppable just a couple of years ago has hit some serious speed bumps. Traditional automakers once loudly committed to electrifying their fleets, but they scaled back dramatically over the past couple of years. The combination of pandemic-induced supply chain problems and inflation pushed many EV prices beyond what consumers could actually afford. And this directly impacts ChargePoint, since fewer EVs on the road means less demand for charging stations. Meanwhile, consumers haven't abandoned efficiency completely. They've just taken a different route. Hybrid sales were up 37% in 2024, capturing 12% of the market compared to just 8% for pure EVs. Consumers seem to be voting with their wallets for a compromise solution. Now for the bull case. Where could ChargePoint be a year from now? First, the company's subscription revenue continues to grow as hardware sales struggle. That recurring revenue stream generally provides higher margins and more predictable income. Wilmer highlighted on the conference call that ChargePoint finished the year with 342,000 charging ports managed by its software, and that directly drives subscription revenue. Second, ChargePoint has shown impressive operational discipline, dramatically reducing the cash burn and operating expenses, and that demonstrates that management is serious about creating a sustainable business regardless of the market conditions. Third, the company's partnership with General Motors could drive significant growth. ChargePoint announced plans to install hundreds of fast charging ports across North America in 2025. That effort is intended to offset upfront investment costs for charging station owners. And finally, ChargePoint's anti-vandalism innovations, including what the company calls the industry-first cut-resistant charging cable, is addressing a major pain point for charging station operators. But the bear case includes several factors that could hurt ChargePoint over the coming year. The cooling industry creates the most obvious headwind. It continues to favor hybrids over pure electric vehicles, and that means that ChargePoint's growth potential is limited. But an even bigger threat comes from President Trump's recent tariffs. Vehicle prices are likely to increase 13.5% on average due to these tariffs, making an already expensive electric vehicle even more costly for consumers. During the earnings call, Wilmer acknowledged this issue, stating that ChargePoint manufactures in diverse locations, including the United States, but the broad impact of vehicle affordability could significantly dampen EV adoption. The company's guidance also suggests that there's going to be continued challenges. ChargePoint projects first quarter fiscal 2026 revenue of just $95 to $105 million, which at the midpoint is essentially flat with the fourth quarter. Despite all the recent operational improvement, ChargePoint is still burning cash. While the company did dramatically reduce its cash consumption, it hasn't yet reached profitability even on an adjusted EBITDA basis. But ChargePoint does aim to be positive adjusted EBITDA during fiscal 2026. For now, I think the single most important metric to watch is subscription revenue growth. This recurring revenue will prove critical for ChargePoint's long-term viability, especially if hardware remains challenging. In particular, watch whether the growth can accelerate beyond the 14% year-over-year pace, which would signal the installed base continues to expand despite industry headwinds. So where's ChargePoint going to be a year from now? Given the industry headwinds and the impact of tariffs on affordability, I think ChargePoint faces a rough road ahead. The company's made impressive operational improvements, but those likely won't overcome the slowing adoption of pure electric vehicles. While subscription revenue continues to grow, I find it hard to see how ChargePoint's total revenue is going to rise or why the stock price is going to increase significantly over the next 12 months without a major acceleration in EV adoption. So with so much uncertainty in the auto sector due to market tariffs, shifting consumer preferences, investors should probably steer clear of ChargePoint stock for now. Are you ready to discover investment opportunities with more promising road ahead? Visit fool.com/invest to find the top 10 stocks to buy right now. That's it for today. If you found this insight valuable, hit that like button, subscribe for more, and help make our community smarter by sharing your thoughts and insights about ChargePoint. Stay foolish, and we'll see you here next time.